Welcome everyone to today's webinar, Private Capital Reporting and Investing for Nonprofits. Before we get started, there are a few housekeeping items I want to go over. So just so you know, you can maximize or minimize the webinar pane during the presentation by using the red and orange arrow buttons. And during the webinar, we definitely encourage you to ask questions. In the webinar pane, you can see a questions box, and you can use that to type in your questions and click submit. During the presentation, and as time allows at the end, our presenters will be answering those questions. I definitely also want to make sure everyone has good audio settings. So if you're using a telephone, make sure you select the phone call audio option. If you're listening through your computer, select the computer audio option. And if you're here today for CPE, just a few reminders, you must be on your own personal computer, no smartphones, and you must be logged in using your own unique URL. You have to be logged onto the online software for at least 50 consecutive minutes and actively respond to at least 75% of the polling questions. Today, there's going to be 4 polling questions, so make sure you answer at least 3. Also, make sure you complete the evaluation survey at the end of the webinar. Today's learning objectives are going to be describe characteristics of private capital, discuss accounting best practices nonprofits can consider when holding private capital investments, and analyze a paced approach to gain vintage year and strategy diversification. And today we have Jason, an investing consultant advising clients on investment strategy, risk management, and portfolio construction. In addition to being a shareholder of the firm, he is the chair of Canterbury's Capital Markets Committee and plays an integral role in determining the firm's micro-investment views. We also have Dean, who after spending 12 years as an auditor, he transitioned to be our chief relationship builder. He helps numerous private, public, and nonprofit companies address their tax, audit, and outsourcing accounting needs. And we also have Mike, who has more than 10 years of experience in public accounting. He specializes in financial statement audits of nonprofit organizations and private and public held mid-market businesses. His nonprofit practice includes private education, foundations, and religious and performing arts organizations. So take it away, guys.
Awesome. Well, this is really good. We're actually going to start with that polling question, and I'm going to give everybody some time. We want to make sure that we have 4 of them, right, Marie?
Yep, yes.
And you got to get them. So you want to get that CPE going. We're going to give you time here. I know there's probably people just logging in, so we're going to kind of slow play this question a little bit. Go ahead. Do you want to read it?
Yeah. So we want to get a feel of how much your organization has in investable assets. So is that under 25 million, 25 to 50 million, 50 to 100 million, 100 to 200 million, or over that 200 million mark? So go ahead and get your answers in.
And like I said, this is CPE worthy, so you definitely want to partake. No wrong answers here.
Okay, so we'll go ahead. So we're going to go ahead and close the polls and see what everyone shared.
All right, big wide range, but looks like the majority of the folks are under $25 million, but you do see a good smattering of size and allocation of size of portfolios. Before we get right into it, I kind of wanted to give everybody the why we're doing this webinar, and it's because one of our private schools last year hit the news. They hit the Wall Street Journal in a good way, and it was because they had a $15,000 seed investment in a company called Snapchat, and when that company went public, it hit the news that they were able to realize and turn that $15,000 into $40 million. So great on them. That's amazing. I think what it might have done also at the same time, and Mike was on that account. He helped do the accounting on that transactions for lots and lots of years. But it definitely brought private capital to the forefront if it wasn't already. And people want to know, how do I do that? And they only hear about the home run, right? They don't know about all the little things that go into managing it, the best practices, the right way to go about it. So today we're excited to partner with Canterbury Consulting and talk about private capital, both from an asset management point of view and from an accounting point of view. So with that said, I'll pass it over to you, Jason.
Thanks, Dean, and good morning to everybody on the phone. And I think that story that you started with is an important one, because We're going to talk a little bit today about why people are considering private capital. That is really the reason why. We're going to talk about what that gets the heart of, which is enhancing your portfolio's return. We're going to talk a little bit about once you've made the decision to allocate to the asset class, what is a good approach? What is the right approach to building out the asset class exposure? And then talk a little bit about what maybe doesn't often get enough airtime, which is challenges and risks. But I want to circle back to that story for a moment and maybe talk about what those types of I wouldn't call it a fairy tale, but maybe one-sided stories in the marketplace have led to, because they certainly do exist. But Dean, you're very accurate that you don't always hear about the $15,000 investment or sometimes a much larger investment that don't end up working out. But there has certainly been a lot of excitement around the private equity asset class. And just to throw out some very high-level numbers around private capital, I'll just say that we are sort of at the peak of the market right now as far as activity. There are 3,800 private equity and private capital funds being raised in 2019 that are targeting just under $1 trillion in capital. So those are numbers that are basically 30% higher than we've seen in previous years. And if you think about what's called as dry powder, and dry powder is defined as the amount of dollars that have been raised but have not yet found a home. So those are people who are looking to allocate their private capital dollars. That number is at $2.1 trillion globally. That number is up from about $1 trillion over the last couple of years, so it's doubled. So wow. that gives you a little bit of a sense of the excitement around the asset class and what we would describe as a challenge, because as everybody knows, when you have too many dollars chasing too few deals, your expected return goes down. So I'll just put that out there, and we'll circle back to that in a moment. But that sort of leads in from your previous story, is people hear the one-sided outcomes and they get excited, and then they sort of follow into the asset class space. So we want to talk a little bit about the right way to do things and maybe the balanced way to do things within the asset class.
Yeah, and Jason, real quick, this is Mike. Good morning, everyone. I'm actually curious, and I'm sure some of our viewers are as well, how accurate this number is. I actually read an article yesterday that of all private capital investments, roughly 40% is made up from tax-exempt organizations, which was surprising to me. I don't know, roughly ballpark, if that's an accurate number for you, but obviously we know tax-exempt nonprofit organizations are heavily involved in the private capital space.
Yeah, absolutely. And a lot of that has to go to their perpetual nature of the pool and their ability to withstand illiquidity. So that certainly seems like a reasonable number.
Wow.
So I'm gonna get started on why consider private capital, building off of that story that Dean started out with, and take a step back for a moment. What we're looking at on this slide is a basic framework of asset allocation. And at Canterbury, we categorize assets into 3 different buckets. The first bucket being what's highlighted on the bottom of this page in the role of the growth of the portfolio, and that's where private capital would go. So the 3 roles on the page are: we want to grow the portfolio, we want to provide capital preservation within a portfolio, and we want to provide protection against inflationary periods. And ultimately, depending on your different organization's objective and constraints, you're trying to find the right balance between those 3 items: growth, protection from risk, and inflation protection, depending on your time horizon, your risk objective, your spending needs, your liquidity constraints, etc. In the vein of private capital, it is fit into the bucket of where can we drive growth from both public and private markets. And if I transition to the next slide, the reason that private capital has been getting more and more attention over the last few years is when you look at this page and when you look at the chart in the middle of the page, we have plotted all the different asset classes that you could allocate to within a portfolio, and then the expected return and risk over the next 10 years as we see it. And these are numbers that, as we look across our peers, are not too different. So if I'm just going to pick a very basic one here for a moment, you see the dot in the middle right side. U.S. equities are expected to return about 5% over the next 10 years annually. And you compare that to bonds, fixed income, which are expected to return about 3% over the next 10 years annually. And most organizations that we come across have somewhere in between a 4 or 5% annual distribution rate. And then you tack on the fact that you have a 2% 2% inflation rate. So you have about a 7% hurdle. That's that blue line going across the page. So if our hurdle rate annually is around 7%, most of the conversations that you may be having with your finance or investment committee is, how are we going to achieve a return from our asset class mix that gets us above that 7% line? And you can see that most of the asset classes on this page are not above that line. So any mix of those asset classes are not going to get us there, and we're going to fall short of that expected return that we need, and we're therefore going to see erosion within our portfolio. And we know that has challenges for our organization. We're not going to be able to support our operations. We're not going to be able to grow the impact of our organization. So the conversation that is happening around many organizations, and we see this every day, is what else can we do within the portfolio to drive the return and continue to protect our purchasing power of our portfolio? And there are different levers that can be pulled. You can try to raise more money, which is often an opportunity, but also a challenge. You can cut expenses and distributions, but I don't have to tell the people on the phone now that is often opposite of what we're trying to do within our organizations, and is an even bigger challenge. And really the other option is, well, we can take more risk in the portfolio. And that's where you see the private capital asset class in the top right corner. It is only one of 2 asset classes that are above that line that offer an attractive return to potentially enhance the return above our hurdle rate. And so this is where you're getting many people who are talking about, okay, well, maybe we should start to consider private capital for the first time. Or for folks on the call thinking about our polling question who have larger portfolios and maybe already have private capital in the portfolio, maybe we should expand it further and make it a little larger, because historically, and we're going to look at this in a moment, private capital has earned between 3 and 5% more than public markets over time. And so that's really where you'll start to see this reason that it comes into the conversation. And that parlays very nicely into that story that Dean talked about, where maybe we're not going to get the Snapchat result where we go from 15,000 to 40 million, but maybe we will go from earning 5 or 6% in the public markets to earning 8 or 9 or 10% in the private markets. And one other item that people are focused on, you'll see the second bullet point on this page, where it says you can focus on an inefficient market. And the reason that people are interested in that is because you're also able to further diversify your portfolio and to drive returns through other means. You're less dependent on just what the market is going to give you, and you're able to drive returns through more operationally focused endeavors. And that's also attractive to our pools of capital, because we're less dependent on things we can't control, and we are theoretically able to invest in managers and strategies where we can have more direction and control through those managers in the returns that are generated. So that sort of sets the stage for why people are having the conversations and why it's timely, given the expected returns, which many people are forecasting to be lower going forward. If the slide that's on the screen now is looking at historical returns. The gray bars are the private equity market. The blue bars is the S&P 500. You'll see over the shorter term, over the 5-year period, it's been basically the same. Over the 10-year period, it's been roughly stronger for the private equity market. A lot of this is an account of that we've had an extremely strong public market for the last 10 years. We've now rolled past the 10-year period where we were in the financial crisis, and we've had an incredible recovery for the public markets. But when you look back over the last 15 to 25 years, you'll see there's between a 4 and 6% premium by investing in private markets above the S&P 500. And a lot of that is borne down to what we call the illiquidity risk. So we need to get paid for all of the burdens we're going to talk about later: illiquidity, complexity, lack of control from doing private equity. And you can see historically, over very long periods, you have been compensated for doing so. But again, we're going to talk about the prudent way to manage a portfolio and how we can try to ensure that we are able to capture historical premium. Moving forward to the way we would recommend building a private capital program and the way we work with our clients to build a private capital program. What I have on the screen now is what you can consider as the asset allocation within your private capital portfolio. For those of you who have already started a private capital portfolio or who are thinking about it, it's very much like building a traditional asset allocation of your portfolio. When you're building your stock and bond portfolio, you start to think about your allocation to large cap stocks and small cap stocks and U.S. and non-U.S. and bonds. Within private capital, it's a very similar structure. There are different sub-strategies of private capital, and we think it's very important that you think about having targets and ranges to get you diversification within different subsets of the private capital market. So you can see on the right side of the page, and some of these are probably more common than others, and I would suggest that the story that Dean opened up with would fit into the third one, the venture capital. This is a focus on startups and early stage companies with long-term and then high growth potential. And I'm guessing in the case of Snapchat, when that investment was made at $15,000, I think it was through a founder. That was in a very, very early stage of that life cycle for Snapchat. And,
the earliest.
And so it was a seed round. And so that is one subset of venture capital. Of the private capital market, excuse me. And so you can see on the pie chart, it is a smaller portion of what we would recommend be a portion of the private capital portfolio because it is a riskier part of the market. Those outcomes are typically binary, where when you do a venture capital fund, there may be 10 to 12 investments in that fund, and there are maybe only one investment like a Snapchat, and literally the other 10 or 11 can be zeros or losers. And so that is why you have to size that allocation smaller. You compare that to the buyout sector, which is the most commonly thought of part of the private capital market. And then the name is sort of indicative of the strategy where a manager or a company goes through a true buyout, typically with leverage, where a control interest is taken over in the company. That is the more traditional private equity strategy, and that is more stable in its return pattern. So as you go through the different asset classes, over time, we recommend building out a very diversified private capital strategy to all these subsectors. Most of them are fairly self-explanatory, but I will point out a couple that are maybe newer to the page. Secondaries is an interesting strategy within private capital. The secondaries market is one where managers and strategies are providing liquidity to what is otherwise an illiquid market. When you're making a private capital investment, you're typically doing it for a very long term. You're typically a limited partner, so you don't have control. And you frankly are not able to go out and like you are with a public market and resell your position in the interim. What a secondaries fund does is it is buying interest in other private equity funds at a discount when they are well into their life cycle of their fund. So there's a couple advantages there. One, you're getting a discount. So right off the bat, you've sort of baked in some sort of protection and return. The second part is these funds are usually 3 to 5 to 7 years already invested. So you are getting a look at what they're invested in, which is beneficial because you know the quality of the underlying investments, and you're speeding up what's called the J curve of private capital. The J curve is often thought of where you make a commitment to a fund. It takes them 3 to 5 years to get invested, and you're paying fees for the first 3 to 5 years, which makes your return go negative at first. And then it takes you that last period where the J comes back up to get your money back and earn your return. When you do the secondaries investment, you're sort of mitigating that 3 to 5 year period because these are seasoned funds that you're getting invested in. So that's a very interesting strategy, particularly for new private equity investors, because you're able to get invested very quickly, you're able to get a lot of diversification, and you're able to get a discount on your initial investments. So that's an interesting strategy that maybe is not overly discussed within private capital. But nonetheless, the takeaway from this slide is the fact that diversification is very important. And when you move to the next slide, you'll see that we call this the quilt of private capital, and you'll see that the returns move around, and this is why diversification is very important. Strategies that are on the top, like venture in 2013, can quickly not be the top returning asset class the next year, like they were in 2012, where they had been on near the bottom. What I will point out though is when you look at buyout, which again we recommend is the largest allocation of your portfolio, it is one of the most consistent parts of the portfolio. You can see if you just drag your finger around the middle, the second and third line, with the exception of 2010, buyout returns are typically fairly stable in performing relative to the other sub-asset classes. So that's traditionally not only a larger part of your portfolio, but more of where you start investing, because it is more stable and less volatile as compared to, as I mentioned, venture and distress, which tend to move around and tend to become later parts of your program and smaller parts because of their volatility.
Jason, maybe we can touch on this real quick. I know you and I have had conversations about, the rush to private capital, and, right now you said it seems like it's really hot. Everybody wants to look at this as an asset class, and there's a right way to to jump in versus, I guess, the cannonball method or the tiptoe method. Maybe you can kind of touch base on that, just on how hot everything is and kind of the right way to get moving in, especially when you see, the board as you have it right now.
Yeah, that's a good point, and I'm going to jump ahead just one more slide. So we've talked about diversification. We've talked about the fact that there's so many dollars chasing the private capital market. And what's good about private capital is also sometimes frustrating for investors, because people do get very excited about the asset class. They say, you sold me XYZ investment consultant. I want access. I want in. But if we said, and what you're looking at on this page is an example. Let's say you have a $100 million portfolio and you want 10% of your portfolio in private capital eventually. Because the way private capital works is you make commitments to strategies and they call those investments down over time when they find opportunities. The good news is you can't get there overnight. You can't just put 10% of your portfolio in private capital tomorrow. There are strategies that will allow you to do that, and I will caution those listening, there are folks out there who will allow you to buy funds that'll get you there instantly. Our recommendation, or really what you were hinting at, I think that was Dean, is to not do that, because what you will forfeit is diversification of what we call vintage year. And if you were to follow a pacing plan, which is what you're seeing on this page, where you make commitments each year over many different years, is you would be forfeiting the ability to diversify by different years to different strategies. And the risk of just going all in 1 year is that you might be picking a time that is a very hot portion of the private capital market and sort of the top of the market, versus if you were to leg in over many different years, you wouldn't just sort of be picking a point in time where you're hoping it's the best year for private capital and rolling the dice. So to answer your question directly, our recommendation is to set your plan up, to set your targets, and then to methodically allocate over many different years by making commitments to different strategies each year in a paced approach. The nice part of that is, again, you'll get diversification over many different years and many different strategies. And then eventually, your portfolio of private capital will become self-funding, because the funds that you committed to in 2019, in a couple of years, will start returning capital, and they'll start funding the new funds that you're committing to in 2023, and you'll no longer have to raise money in the rest of your portfolio to fund those capital calls. But we definitely recommend that you pace into the different strategies over time versus picking just 1 year and saying, this is the year we're going to build out our private capital portfolio.
Got it.
And if you look at this slide, a sand chart, you'll see how that plays out over time. And we recommend starting with buyouts and what's called secondary funds, as I described them earlier, because again, they're the more stable parts of the portfolio. And secondaries, as I mentioned, you do get that protection of discounts, and you do get that diversification of buying seasoned funds across many different types of strategies. So
Jason, real quick, can I jump in here? One of the things that I wanted that I noticed here was, and it's something that we hear about a lot in the public markets, or people who are trying to get into companies that could potentially go public is, I believe what you have here is the growth line. It's like more mature companies that are private that might be going public. Is that kind of that sector? You know, like for example, everybody wants to know when Uber and Lyft are going to go public, right? Are those companies that would be considered in the growth sector?
Those are a little more mature. I mean, typically growth capital is thought of as companies that are a little more immature, that are looking for just capital to expand their operations. Those are companies that are sort of just right on the cusp of IPO and in the later stages of their they've had many rounds.
Right.
There are interesting strategies for those companies where actually people who are within the company are looking for liquidity. There's some interesting strategies where you've got, employee number 7 who maybe isn't very high up in the company, but they do have a significant amount of shares, and they would just like a little liquidity, and they're probably going to be locked up for a few more years, so they're willing to sell some of their shares even before the IPO goes off. And there are managers who have strategies to offer liquidity to the partners in those firms, and those are some interesting strategies to look at, because you can get access to those companies right before they go IPO, and help diversify your portfolio to those private companies before they really turn public.
Great. So majority then of this is much more not immature, but more on the earlier side. Sounds like.
Say that again.
More on the earlier side with regards to the venture and the growth and some of the other the growth trajectory categories.
Right.
Okay.
I'm going to keep going into the last section, and then I'll take a pause and open it back up to the folks from Armanino. But we've talked about the why is higher returns. I went a little bit into the weeds on the strategy, and I think it's really important though to talk about what to be cautious about, the challenges and the risks. And I know Dean and Armanino is going to go into some of the reporting and some of the regulatory challenges as well. But there are some investment considerations. The first one, these are illiquid investments with very long time horizons. So from our standpoint, before you move into this asset class, it is extremely important that your investment committee, your finance committee, your board, your organization sits down and make sure from an investment policy standpoint, you understand a couple things. What is your philosophy and ability to have an illiquid portion of your portfolio, both from an ability of the organization to withstand a drawdown and how the illiquid portion will react to that? Will it become so large that you can't withstand the illiquidity? Are there covenants in the portfolio that's going to have problems with? What is the term of your investment committee? Does your investment committee turn over very often? We see this with a lot of independent schools, where just by nature of the parents that are on the schools, one group of parents are very big fans of private capital, and 4 or 5 years later, we have a new group of parents, and they're a little less comfortable with illiquidity in the portfolio, and now you're into stuff that you can't get out of, and you want to make sure that you've built the right infrastructure and philosophy that's going to be able to live with the life cycle of these investments. So really understanding how this is going to fit into your portfolio long term and setting those objectives and defining it early on is important, because you're truly getting married to these investments, and it's important to understand that before you go in. They are level 3 assets. I'm going to let Armanino tackle that a little bit more, but there are a lot of reporting and other things to be mindful of before you get into the investments, because it's obviously too late once you do. Additional management of ongoing calls and distributions. Who's going to manage that? Who's going to track the calls? Who's going to track your unfunded commitments? Who's going to make the capital calls? Just to understand what goes into it, because it's not your traditional investment where you just set it and forget it. There is more management going on. Limited control over vehicle and execution. It's extremely important to pick the right strategies and the vehicles. So understanding that is really important. The last 3 I'm going to sort of lump together under manager selection. These are more expensive investments. They come with higher fees. They are large dispersion of returns between the top quartile managers and really everybody else. If you're not in the best funds, it really doesn't make sense to invest in private capital because they don't outperform the benchmark and they don't outperform the public markets. And if there's too much leverage in a strategy, when things don't go well in the market, it can sort of unravel everything else. So I put that in the category of how are you getting access to the strategies? How are you selecting them? How are you following them? Who has those responsibilities? And the table in the bottom of the page is a sample of Canterbury's reporting page, one of our reporting pages, because over time you can see you're going to develop a portfolio of these various investments, and there are different things to track. What are your commitments? How much has been invested so far? How are they performing? And so we help clients track all of those things because they're extremely important to not only monitor but also report on regularly. If I've gone to the next slide, and I'm going to circle back to a couple of those things. The first one is this data on the bottom left side. What you're looking at is the last 11 or so years. It starts in 2003 and goes through 2013. The reason it stops in 13 is because the last 4 or 5 years or so of private capital data is too immature to draw any conclusions from, meaning those funds are still getting invested and we don't have the results of those investments yet. But we can look back over the 10 years before that and see how have managers done. And what you'll see is the top 25% of managers have earned IRRs above the benchmarks, and the bottom 75% are really below the median. So this confirms what I was saying a moment ago, where you need to be in the top 25% of the investment managers within private capital, or you're simply just going to lag behind. And so that's why manager selection is extremely important. So I'll just close by saying Canterbury's been doing this for a very long time. We have over 20 years of experience investing and helping clients with private capital. We allocate around $200 million a year to the asset class. It is a customized approach for each client. So all those items I mentioned, illiquidity sensitivity, your investment committee's biases, your organization's objectives and constraints. You'll see the range by client. We had a poll question earlier where it was a large range. We have some very small clients that are approaching this through a fund of funds. We have some very large clients that are doing this through a direct nature. But I think what's most important is from the diligence of the managers to the selection to the managing of your capital calls, the ongoing monitoring, reporting, audit assistance. That's where our team steps in, and frankly, it's offloaded to us so we can help manage the whole process for clients. We have our OCIO business, which is our outsourced investment management business, where clients can outsource the entire process of their portfolio management, including their private capital portfolio, or they can just outsource the administrative portion if they want to retain the selection portion, which some clients like to be involved in selecting the managers. But I do think before clients get involved in this asset class, it is important to understand that it is a little more nuanced and burdensome to monitor and track and diligence. And so having the right partner to work with in those sections is very important. And it's something that we're very experienced in and been doing for a very long time.
Awesome. Jason, real quick, when you see this slide, as you noted, manager selection is everything. And so I guess the burning question is, a couple top criteria that you guys recommend when looking at manager selection. Is there a top one or two that automatically come to mind that just, that you'd like to share here?
Yeah, absolutely. So, well, there's one sort of qualitative and then there's one sort of quantitative. So the quantitative is track record, and it sounds basic and intuitive, but it's true. There's a lot of data out there that suggests that funds that have performed in the top quartile are significantly likelier to continue to do so in their future funds. Past performance is not, I'm going to sound like the SEC here. Past performance is not a guarantee for future results, but it is significantly indicative of the ability to do so. And it's not just because they've done it, they're going to be able to do it going forward, but it's because what we look for is what is a manager's investment edge, what is their process, and is it repeatable? And so if we can identify those three things, then we think that they're probably going to be able to execute going forward. And so we definitely look for track records. We don't often do first funds of managers because it's very hard to underwrite those three things unless, and this is a big point, we've identified a team that was at a different firm before, we can validate their track record, and they've now left or been lifted out to start the same strategy on their own, and we can get some sort of understanding of what they've done previously. The more qualitative one is just understanding the access, both that they have within their different networks and industries, and then also Canterbury's access. We've recruited and hired people in this asset class in our research team that have relationships into the right funds, because you can identify the best performers all day long, but if you don't have the relationships to get your clients access, it frankly doesn't do you any good. So you've got to be able to identify the right strategies, and then you've got to be able to secure access to those strategies, because back to those numbers I started with, Dean, in today's world, so many dollars are chasing this asset class. If you can't get access to them, unfortunately, it's sort of all for naught.
Right. You're going to be chasing bad returns. That's awesome. Very great insight. Thank you so much, Jason. That's very, very good. Let's move to our next polling question.
So just as a reminder, we have 4 polling questions, so make sure you answer at least 3. The question is, does your organization hold and report in its financial statements private capital or other alternative investments holdings? So yes, no, or not sure.
Yep. And if you missed the last polling question, you definitely want to get in on this one. So we'll give everyone time to get in here and make a selection, so we make sure you get your CPE. Yeah, very cool to hear, though. I mean, yep, past returns and relationships, proven commodities, and all of that. That it seems like we hear that in so many different things, right, Michael?
Absolutely.
Yeah, we hear that over and over again.
Perfect. We'll go ahead and close the polls.
Not surprising results, right down the middle, a mix of people holding these already and reporting them in their financial statements, and some that are not. And I think that's a perfect segue to the next piece of content we want to go over here to round out the hour. This is Mike again, and happy to talk about some considerations now that we've heard all the great, exciting information from Jason and Canterbury around the opportunities you have in the private capital markets, some of which you are already in it, some of you are not. So this goal really is to give you some things to think about on the administrative burden, perhaps, on the financial reporting in your financial statements, just some of the implications, things to think about.
Well, I mean, for sure, what jumped off the page was, the fact that these are illiquid, right? And we all know, if you're a nonprofit out there, we have a liquidity standard coming up real quick. So, you definitely want to get out in front of this and be strategic as possible.
So we'll talk a little bit about that. But, Dean shared that fantastic story, a huge success story of the private capital opportunities. And we've heard them time and time again of foundations, private education institutions, other public charities that have reaped the benefits of some of these investment vehicles, ultimately generating the operating income, flexibility, endowment growth. It's allowed them to expand geographical presence, program-oriented mission impact. So huge opportunities for them, and we want to make sure while you embark on some of those discussions that you're considering some of these implications, things to think about. Some will be simple, very simple. Some will be some things to food for thought for later, and certainly chat with some of your other external advisors, accountants, tax preparers. We'll go through some of these. So really what I want to focus on for the next couple minutes, 3 particular areas, some additional accounting processes, workflow, things to think about on the administrative side if you're holding these types of investment vehicles. A quick comment on unrelated business income tax. Really, we don't want you to be caught flat-footed or surprised on that front. And then lastly, to the extent we have time, we'll go through a little bit of the new nonprofit financial reporting rules, which we've done in depth in past webinars, and you can access those recordings to really take a deep dive on the rules. But we'll talk about liquidity specifically and a few areas where these private capital investments will impact the story you're telling on your liquidity disclosures under the new rules. So some things to think about on the administrative side. A couple real quick points. Jason touched on a few as well. Might depend on what you're doing yourself versus outsource it. Particularly if you have that OCIO model, you may not need to worry much about this, but if you don't, some of these things you'll be tackling on your own and the accounting and finance team within the organization. First and foremost, new fund statements. You get into these private capital investments, just another piece of paper to look at. You'll get reporting and the simple task of determining the debits and the credits of how to recognize those gains, hopefully, and not losses, understanding carried interest, other capital commitments. It just takes a little bit of time to understand what you're looking at so you can set your repeatable process in place for recognizing that activity in your financial statements. Fund commitments, Jason talked about this. Many of these private capital investments are commitment based. So if you aren't familiar with that, or if you haven't entered into that before, you'll subscribe with the fund to a particular dollar value, let's say 10 million, which will be called upon periodically moving forward as the manager makes capital calls. So of course you need to keep an inventory, so to speak, of your unfunded commitments, the amount of cash you may be committing moving forward. And as you can imagine, that's a significant impact to your liquidity disclosure in your financial statements on the cash you have on hand, but it's earmarked. It may need to be used in the future as capital calls are made. So keeping track of that inventory, hopefully your investment manager helps significantly with that. But to the extent they're not, or you need to supplement that, that's something to add as far as a workflow internally to keep track of those fund commitments. Off-year reporting is an interesting one to think about. Many of our nonprofit clients are June 30 fiscal year ends. Many private capital investments are not. They're calendar year end, right? So there'll be some timing differences you may experience as you start looking at reporting from the fund managers, particularly Form K-1s that come to you if it's a partnership structure. There'll be some timing differences between a calendar year versus a fiscal year, and you need to keep that in mind. Most notably, it might actually change the time horizon or the time window you look at as you close your year. You close your books, you go through an audit process perhaps, preparing your own tax informational filings. That timeline may be stretched a little bit as you first enter into these investment vehicles. You may need more time to collect data from the fund managers, the K-1s, the statements, and aggregate that information for your own internal purposes. So keep that in mind. And then year-end valuation. As accountants, CPAs, financial statement auditors, this is of heightened importance to us, and it should be to you as well as you have these types of investment vehicles. They are highly illiquid at times, as Jason elaborated on. They are, under the old rules, what's called a level 3 fair value input. Typically now, the way those funds are structured, they'll report to you what's called a NAV, or net asset value per share, a unitized basis, that if it meets certain criteria under the FASB rules, you can effectively take a shortcut to determine the fair value that goes into your financial statements and place some reliance on that net asset value per share that's reported to you by the fund managers. But that's something to keep in mind. As you close your books, as you go through a financial statement audit, it's going to be of heightened importance to the auditors. It should be to yourself. It will be to the audit committee. They want to make sure that those values are accurate and reasonably stated, albeit even if they are directly reported from your fund manager. So unrelated business income tax. Again, a quick comment here. Just wanted to make sure folks are aware of this. I've had a few clients enter into some private capital investments for the very first time. And unfortunately, I think their investment managers didn't give them a heads up on this potential investment cost. Some of these private capital investments are structured in a way where in particular, they may be debt leverage, and that may trigger unrelated business income tax to its tax-exempt investors. You may not know that dollar amount at all until they report it on the annual K-1 reported to the investors. But once you receive that, you have a dollar value that's deemed unrelated business income tax as a tax-exempt organization. You may owe tax on it if you have a net income from that activity. If you've never filed a Form 990T, that'll be an additional burden, additional cost to go through as an organization to be in compliance with this. So don't be surprised. Make sure you're asking these questions ahead of time. I'm sure, Jason, you can comment quickly what you do with your clients in terms of making sure they're aware of this and how they evaluate it in terms of entering into investment vehicles, whether this is a deterrence or just another cost of investing.
Yeah, absolutely. And I see there's a question about an example of when UBTI might occur. Typically, it's around around debt and associated income around that. And I think what we try to do with each strategy is ask the client if there's a sensitivity. Some clients, frankly, have a zero tolerance because it's just not worth the reporting burden. Other clients that are already going through some of their filings are less sensitive to it, and they'll just pay the tax. But what's nice is a lot of managers will know ahead of time if there's any risk of it, and if there is, they have what's called blocker structures in place where you can sort of opt out or you go through a blocker structure to try to prevent as much of it as possible. So I think this is something that's probably not talked about enough, and then it's just really frustrating down the road. So definitely ask your advisor if not, or hopefully your advisor is proactively telling you that this is a possibility and the ways to avoid it.
Yeah, absolutely. And just to hammer home Jason's comment, this is out of your control as the investor, as the nonprofit organization. Sometimes this is triggered purely based on how the fund is operating and how they are leveraging their investments. So you don't have a choice. It's reported to you. And unfortunately, that's the case. But you can plan ahead and make sure you're modeling it out correctly if it's significant enough. And if it's not, it's another cost of doing business and hopefully generating those positive rates of return that you were seeing earlier. So a couple of those quick considerations we talked through, again, just to get your thinking hats on and considering some things to think about moving forward. If this is the first time you're getting into these investment vehicles, or if you're seasoned in it, hopefully validating some things you're already doing so that you have a good process in place. We want to talk a little bit about the new FASB nonprofit financial reporting rule. Again, it's particularly related to liquidity and how these private capital investments will impact your disclosures. Again, I mentioned this has been talked in depth on past webinars. You can look them up. As a very brief reminder, this is real. It's now. It's effective for 12/31/18 year-end organizations, or if you're a June 30 fiscal year-end 2019, you'll be implementing it for that year as well. So it's happening now. We're talking about this, I feel like, daily with our nonprofit clients, with the other rule updates, not just the liquidity disclosure, but some of the functional allocation of expenses, if they're changing their cash flow presentation. There's a variety of factors in this rule, but today we're just going to focus on that liquidity item right after we do our polling question.
This is our third one. You need to click 3 out of 4, so let's get to it.
Do you feel ready to implement the new nonprofit financial reporting rules? So yes, no, I need more time, or I don't know what the rule changes are. So go ahead and answer our question. Okay, and we'll give everyone about 3 more seconds here. And we'll go ahead and close the polls.
Great to see. Roughly over 60% of the audience feels ready, prepared. Maybe you've already done the work. That's fantastic to see. Those of you that are not ready yet and need some more time, you have a little bit of time. That's okay. We're here to help if you need as well. So we'll get there. So diving into a couple of these, again, just for those of you that are ready and maybe you've already done this work, these are some good reminders for you. And maybe if you're still drafting those footnote disclosures, this will help you formulate some of them and give you food for thought. What's the objective as we talk about the liquidity piece of the nonprofit reporting standard for nonprofit organizations? Really, the goal is to inform your readers, the users of your financial statements, give them more information about how you assess liquidity, how you as a nonprofit manage your exposure to liquidity risk, so you can see how this layers perfectly with private capital investments. If you have those and the illiquid nature of them, that's going to be part of the story you're telling and part of the information you're giving to the readers of your financial statements. So what are the requirements? If you've seen this before, to look familiar, you need to disclose information that's of qualitative nature and as well as quantitative information around your liquid financial assets that are available to meet your cash needs. The qualitative information will be in a paragraph form or a narrative, a story that you can tell in your financial statement footnotes about how you manage those liquid resources. And then a quantitative tabular format likely in the footnotes as well, disclosing the financial assets you have available and then how those will be used moving forward to meet your cash needs. This may also be presented just on your balance sheet, right on the face of the financial statements. If you use a classified balance sheet, short-term versus long-term, that'll help a reader understand what financial assets are available over the next 12 months versus of a long-term nature. So when we talk about liquid assets, financial assets that are available, what do we mean when we talk about them being unavailable? This is a quick table that's helpful. We've seen many clients use this as they develop their disclosures, their liquidity policies. What financial assets are unavailable to meet their cash needs moving forward? The real three criteria to think about on the left side here is the nature of the financial asset, what external limits there are, donor imposed laws or contractual external limitations on your financial assets, and then internal limitations. So those made by your governing board designated net assets, maybe internal limitations based on your investment policy statement or your liquidity policy on how you've earmarked internal assets for use or long-term investment. What we want to focus on today is that top section, the nature of the financial asset, and really that third bullet point in particular, financial assets that cannot be converted to cash. And when we talk about private capital, that's because they may not be redeemable within 1 year. If they have lockup restrictions for a long period of time, sure, you have the asset on your balance sheet, but we're going to disclose in the financial statements the liquidity exposure you have because they are not redeemable in the short term. You cannot use those cash proceeds to fund operations. When we talk about that quantitative disclosure, here's a quick example just to give you a visual of what it might look like for an organization that has illiquid investment instruments. This is one option to present the quantitative information showing all your financial assets as of your fiscal year end, and then deducting off of that those assets that are unavailable to use for general expenses within the next year, arriving to a net number of liquidity. And you can see the third asset, investments. So this particular organization has $45 million of investments, but in red, you can see we're deducting off $25 million of that because those assets are locked up. They're not redeemable, they can't be used. So they're telling a reader, really your net position of liquidity available to meet needs is much less. So you can see how this changes the story you're telling. An organization previously may have been touting their large financial assets, their portfolio of $45 million. And now these disclosures are telling your readers it's a much different picture. We have lockups of $25 million. We can't access those funds. We have a much lower number of financial assets available to use. And on the qualitative side, again, the narrative that you might include in those liquidity disclosures, some things to think about as you build that out and work with your accountants or other external advisors on what to include. You can see some considerations here, how you manage your cash flow. Maybe you have cyclical cash flow, and that's an important item to highlight in this disclosure. Do you already have reserves set aside? Are there board designations on those funds, lines of credit? And then again, for today's purposes, those private equity investments, do they have redemption restrictions, lockup requirements? Do you have future capital calls coming that you know of? What's your unfunded capital commitment balance? Tell a reader the future cash outlay you're going to make to increase your private equity investments. All part of the story you want to tell and paint your organization in the best possible light while giving your readers an understanding of your liquid position.
Awesome. And we're going to end with our last polling question. What impact do you see the new liquidity disclosures having on your organization's financial statements? Positive, negative, or it depends?
This is the last question, so go ahead and make sure that you reply.
Okay, and we'll go ahead and close the polls.
That's about what we would expect to see.
Yeah, I think many organizations are going to see these liquidity disclosures as a positive, highlight what you're doing well, highlight how you manage your cash flow and the positive financial assets you have available. And then there's going to be many where it depends. Absolutely.
Yeah.
What's the picture for that particular year? Well, how are the markets doing as of your fiscal year end? If it's a June 30, that could drastically change depending on how the market does and your financial assets available.
Yeah, the biggest thing I would say is get out in front of it, right?
Absolutely.
Work with your team, work with your executive director, your CEO, work with your CFO, work with even your advancement director, right? Everyone who is outward facing and saying, hey, what is the story? Work with your board, saying what is the story that we want to tell here? What's coming up for us on the horizon strategically that we might need these financial statements for, and how can we use them as a tool for us going forward?
Absolutely. Plan ahead for that story you're going to tell. And as we've talked about today, those private capital investments are excellent opportunities, but just make sure you aren't painting a different picture when it comes to drafting your liquidity disclosures if you have significant lockups or redemptions and can't access those funds.
Right. With that said, we'll give everybody, another minute for questions. If not, we'll give you guys a couple minutes back in the hour. We really thank everyone for joining us today, especially Jason. Thank you for all of that insight into private capital. That was really, really good. And we look forward to chatting with everybody in our next webinar or at one of our live nonprofit events, either in the Bay Area, Los Angeles, or Dallas. And with that said, thank you, everyone, and we'll get together soon.
Thank you.